Right now, at this very moment, two of the most powerful countries on the planet are quietly fighting over a single metal, not oil, not gold, silver. And if the signals coming out of Asia, out of Washington, and out of the Mexican highlands are saying what I think they're saying, then what's unfolding in front of us right now may be one of the most consequential resource struggles in modern financial history. Most people watching silver charts today are looking at lines and candlesticks and asking whether a breakout is coming. But that's the wrong question entirely. The right question is why two superpowers are treating this metal like it's suddenly worth going to war over, because that's exactly what the data is suggesting. And once you see this, you cannot unsee it. If you've been following silver for any length of time, you've probably noticed that element axis covers this market from a completely different angle than most. We don't do hype cycles. We don't chase headlines for clicks. We follow the actual mechanics underneath the market. The supply pressures, the institutional behavior, the geopolitical undercurrents that most financial media doesn't even want to touch. If that kind of analysis is what you've been looking for, hit that subscribe button right now, because this is exactly the kind of deep framework content we put out consistently. Drop a comment too, even just a word about where you're watching from, because it genuinely helps this channel reach more people who are trying to make sense of what's going on. Now let's get into it, because this story has layers. Let's start with where silver is right now in the spot market. It's been hovering around $88. And for weeks, it's been running the same playbook. It moves up toward that $89 zone, gets pushed back, cools down, and then comes right back up to test that same level again. If you've been watching it, it can feel almost frustrating, like the metal wants to move, but something keeps holding it back. But here's what's critical to understand. That technical picture is almost a distraction from what's really happening beneath the surface. Because at the exact same time this $88 to $89 battle is playing out on the global spot market, something dramatically different is happening on the other side of the world. Shanghai just came back online after the Chinese New Year holiday. And when that market reopened, silver wasn't trading at 88. It wasn't at 89. It opened above $100. Think about that, $100. While the rest of the world's traders were grinding out a fight over a single dollar range near 89, buyers on the Shanghai Futures Exchange were willingly paying roughly 14% more than the global benchmark price just to get their hands on physical silver. That is not normal. A premium that size on a market of that scale tells you something urgent is happening, something that goes well beyond standard supply and demand mechanics. And when you dig into why that premium exists, the story you find is unlike anything this market has produced in a long time. Here's the claim that made me stop everything I was doing and reassess the entire picture. China's state media has been circulating an accusation that the United States government has plans to overthrow Mexico's government and take direct control of the country's silver resources. The number attached to those resources, $600 billion. $600 billion. Let that number sit for a moment. This isn't a fringe blog making noise. This is state-controlled media in Beijing, which means when that story goes out, it goes out because the government wants it out. China doesn't let its media apparatus publish accusations like that accidentally. When Beijing's machine points a finger at Washington and says, "You are planning to take our neighbor's silver," that is a deliberate message. And messages like that don't get sent unless the sender feels genuinely threatened. So the question you have to ask is simple. What is China so afraid of losing? The answer is the backbone of everything I'm going to walk you through today. Mexico is the single largest silver producer on Earth, not by a small margin. Mexico produces approximately 202 million ounces of silver every single year. That represents roughly 22% of the entire world's annual silver output. A full quarter of global supply comes from one country, and that country is currently in a state of serious internal instability. China knows that. Washington knows that. And both are moving around it in ways that, when you line them up side by side, start looking less like coincidence and more like deliberate positioning. Let's put the full global production picture in context, because the numbers here matter. Mexico sits at approximately 202 million ounces per year. China comes in second at around 109 million. Peru is third at roughly 107 million. Then the drop-off is steep. Chile around 52 million, Bolivia around 42.6, Poland at about 42.5, Russia around 39.8 million. Add just the top two, Mexico and China, together, and you're already at over 300 million ounces, more than a third of everything the world produces in a year. And here is what makes this genuinely alarming. Both of those top producers are under stress at the same time. Mexico from internal political and security collapse. China from its own strategic decisions around silver exports. When the number one and number two suppliers are both strained simultaneously, the math for the rest of the world gets very uncomfortable, very fast. Now let me spend real time on Mexico, because I don't think most people following silver right now fully appreciate how serious the situation on the ground is. This isn't low-level instability you can write off as background noise. What's happening in parts of Mexico is closer to an active conflict between organized criminal networks and government and civilian forces across multiple states. And the regions where this conflict is most intense are not remote, uninhabited areas. They are, in many cases, the exact same regions where Mexico's most productive silver mines operate. The major silver-producing states in Mexico include Zacatecas, Durango, and Chihuahua. If you know anything about the current security situation in Mexico, those names register immediately. These are among the most cartel-affected, most violently contested regions in the entire country. The roads that supply trucks use to move mining concentrate and equipment are the same roads organized criminal groups use to control territory. The physical movement of silver production from ground to market runs directly through some of the most dangerous corridors in the country. Think about what that means practically. Workers who need to commute to remote mine sites are weighing that commute against real personal safety risk. International mining companies that normally rotate expatriate managers through those sites are quietly pulling people out. Supply chains that rely on regular road transport are getting disrupted. People in the commodities space, people with actual ears on the ground in these markets, have indicated that at least 2 major Mexican silver operations have already been quietly reducing shifts because workers are hesitant to make the trip. That won't show in official production data for months, but it's happening. And when it finally does show up in the numbers, the repricing won't be subtle. What makes this even more significant is that Mexico's production was already trending downward before any of the current instability. The country's output peaked at around 212 million ounces back in 2021. Since then, it's been slipping. Older mines are getting depleted. New exploration is slowing down because regulatory uncertainty combined with active security risk makes it nearly impossible to justify a billion-dollar development commitment in a region where your equipment can be seized and your workers threatened. Nobody funds a major new mine build-out under those conditions, which means the trajectory here isn't toward recovery, it's toward continued decline. The instability doesn't fix the depletion problem, it accelerates it. And then, into all of this, the President of the United States made a comment that, placed against everything else in this story, sounds less like a casual political statement and more like a signal. He publicly floated the idea of sending American military forces into Mexico to take on cartel networks, framing it as something the United States would be honored to do if asked. From a domestic political perspective, you can read that any number of ways, but from the perspective of someone who watches commodity markets and who is looking at where a quarter of the world's silver comes from, having American military presence or influence in Mexico at this particular moment would put the United States in a position of significant leverage over global silver supply. Whether that's the intent or not, the effect would be the same. And that leverage matters right now because China needs Mexican silver badly. China is scaling solar panel manufacturing at an almost incomprehensible rate. Silver is a core input in solar cell production. And there's no viable substitute at the scale China operates at. Beyond solar, silver is embedded throughout China's electronics manufacturing base and advanced industrial applications. The country's consumption is enormous and growing. China's own domestic output, at around 109 million ounces a year, isn't sufficient to meet that demand. So China needs external supply. Mexico is the most significant source of that external supply. If Mexican output becomes unreliable, and it's already under real stress, China has a serious structural problem, and the way China is behaving, paying 14% premiums, reclassifying silver as a strategic material, restricting exports to just 44 licensed companies, suggests that Beijing is not just aware of the problem, it's afraid of it. When China restricted silver export licenses down to 44 companies, that's not a routine policy adjustment. That's a government deciding this metal is too important to let flow freely based on normal market forces. They place silver in the same category as rare earths and other materials they've previously used as leverage in trade disputes. When you restrict exports of something that aggressively, you're either protecting domestic supply or preparing to use access as a strategic tool. In China's case, it looks like both, hoarding what they have, paying premium prices to pull in more, and restricting the outflow simultaneously. That's not casual accumulation. That's treating a metal like it's going to matter enormously in a conflict that hasn't fully arrived yet. If you're finding this valuable, share this video with someone you know who follows precious metals or who has savings they're trying to protect. A lot of people in that 45 to 60 age range are sitting on portfolios heavily weighted toward American financial assets. They deserve to see this framework. Hit the like button too, because it helps more people find this content. And leave a comment below telling me whether you think this financial war narrative is real, or whether you think it's being overstated. I want to hear your analysis. Now here's where the story takes a turn that even experienced silver watchers haven't fully processed. There are reports, And I want to be clear, these are reports rather than confirmed facts. But the sourcing is serious enough to not dismiss, suggesting that major Chinese technology companies, including Tencent and Alibaba, are in discussions about rotating out of United States financial assets and redirecting that capital into physical silver. These are two of the most valuable corporations on Earth, combined worth trillions, and the suggestion is they may be looking to sell American stocks and American bonds and use those proceeds to acquire physical silver. The implications here move in multiple directions at once. If significant selling pressure hits U.S. equities from Chinese institutional actors, that's a drag on American markets. If significant selling pressure hits U.S. treasuries at the same time, bond prices fall, yields rise, and the cost of U.S. government borrowing increases. The United States is already running an annual deficit in the range of $2 trillion. Higher yields mean higher interest expense on all of that existing debt. So a major Chinese rotation out of American financial assets and into silver doesn't just create demand pressure on silver, it creates financial stress on the United States across multiple fronts simultaneously. Selling pressure on stocks, selling pressure on bonds, buying pressure on silver, one capital flow punching three markets at once. And the reports don't mention $100 billion. The claim being circulated is that China may be considering redirecting up to $3 trillion of its foreign exchange reserves into silver by the third quarter of 2026. $3 trillion. Against a market where the entire estimated above-ground global silver stock is valued at something in the range of $15 to $20 billion at current prices. The math breaks almost immediately. You cannot buy $3 trillion worth of silver at 88 an ounce. Because that much physical silver simply does not exist at that price. What happens when enormous capital tries to enter a tiny market? The price reprices violently upward, until some new equilibrium is found at a completely different level. Whoever holds physical metal, at the moment that kind of capital tries to enter, holds all of the pricing power. And right now, China appears determined to be that entity. Here's the COMEX piece, because it ties the whole picture together. COMEX is the main commodities exchange in New York, where physical silver is vaulted and where futures contracts get settled. The heartbeat of the Western silver market. For months, inventory in those COMEX vaults has been declining, month after month. The registered stockpile available for delivery has been shrinking, metal is leaving, and not coming back at the same rate. When inventory at the main Western delivery hub keeps contracting in the middle of a demand environment like this one, that is a signal that deserves serious attention. It aligns directly with every other piece of the picture we've been building. Tie it all together with the deficit data. The Silver Institute estimated a global silver deficit of around 67 million ounces in the most recent reporting period, meaning demand exceeded mine supply by that amount, and the gap was filled by drawing down existing stockpiles. Stockpiles that are already thinning. That figure assumes Mexico is producing at relatively normal rates. Remove a significant portion of Mexican output from the equation, and the deficit doesn't grow modestly, it explodes. You're suddenly looking at a potential shortfall so large, the market has no clean mechanism to absorb it. Without a price adjustment that would genuinely shock most observers, we're not talking about 10 or 20%. We're talking about multiples. I want to be real with you about the risks here, because honest analysis requires giving you both sides. The first major risk is that the Chinese reports about a $3 trillion reserve rotation are significantly overstated, or fabricated for strategic messaging purposes. State media in Beijing uses narratives as instruments of statecraft. They float stories that serve political purposes, without those stories necessarily describing actual government plans in detail. So it's entirely possible that the 3 trillion figure is inflated, but even if the number is inflated, the Shanghai premium above $100 is real. Real money paid real prices. You cannot fake that with messaging. The export license restriction to 44 companies is real. Something structural is genuinely happening on China's end, regardless of the exact scale. The second major risk is de-escalation, if trade tensions cool meaningfully, if Mexico stabilizes faster than expected, if the geopolitical rhetoric dials back. Silver could give up its current premium fairly quickly. A metal priced partly on fear can retrace fast when that fear diminishes. But look at where the momentum is actually pointing. Tariffs are escalating, not declining. Hoarding is continuing. Mexico's situation looks worse now than 6 months ago. The rhetoric has been getting louder, not quieter. That doesn't guarantee the future, but the current direction is not pointing toward rapid resolution. Let me give you the realistic price frameworks that make sense when you look at this. Honestly, these are scenarios for thinking, not guarantees, not financial advice. In the most conservative scenario, where the Chinese reports are significantly exaggerated, and only a small fraction of that capital enters the silver market, and where Mexico's output declines but doesn't collapse, Silver could still realistically push toward $150. The structural deficit was already there before any geopolitical stress. Even moderate tightening from here would be enough to push a market already in deficit to substantially higher levels. In what I'd call the base case, where China deploys several hundred billion over a 12-month period, where Mexico's output drops 15 to 20% due to security disruption and ongoing depletion, and where COMEX continues to drain, silver reaching $250 to $300 by year-end becomes a plausible outcome. Demand increasing substantially while supply simultaneously contracts doesn't produce gentle price appreciation. It produces sharp, disorienting repricing. In a full escalation scenario, where China deploys capital at the scale being reported, where Mexico sees severe and sustained disruption, and where COMEX faces delivery stress. Price levels in the $400 to $500 range begin to have a logical basis. Reduce a quarter of global supply in a market already in deficit. Inject demand capital that is multiples of the entire above-ground market value. And the balancing price can reach levels that look extreme from where we're sitting today. The reference points stop applying. There's a larger framework I keep returning to. Financial conflicts between major powers don't always look the way we expect. They don't always involve tanks or naval standoffs. Sometimes they look like central bank gold purchases happening quietly over years. Sometimes they look like export restrictions dressed up as domestic policy. China's accumulation of gold over the past several years is well documented. Central bank buying, reduction of dollar exposure, conversion of reserves into hard assets. Gold moved from under $2,000 to well above $5,000 as that process played out. The people who understood what was happening early were positioned for that move. The people who dismissed it as noise watched from the sidelines. If what we're seeing in silver represents similar intentional strategic positioning, but in a smaller and more easily disrupted market, on a faster timeline, the implications are significant. China may have moved on gold to reduce dollar exposure gradually and defensively. Silver appears to be a different kind of play. Silver is something China needs for its own industrial survival. Solar panels, electronics, advanced manufacturing, military applications, the industries that power its entire export economy. If the United States is in any way positioning itself to gain leverage over silver supply through its relationship with Mexico, that puts China in a genuinely uncomfortable position. And uncomfortable positions in strategic resource competition produce exactly the kind of aggressive accumulation and public messaging we've been watching come out of Beijing. What makes silver the ideal pressure point in this kind of conflict is the asymmetry of dependence. China's economy is more deeply integrated with silver-intensive industries than the American economy currently is. Solar manufacturing, consumer electronics, large-scale industrial production. These are areas where silver sits deep in the supply chain, and where substitution at scale is either impossible or prohibitively expensive. Squeeze silver supply hard enough, and you're not just raising a commodity price, you're impeding the production capacity of sectors that China considers fundamental to its economic and geopolitical ambitions. That's the lever. And based on the pattern of moves we've been watching, one side appears to be reaching for it. I want to address something directly, because I know some of you watching this are going to think it sounds like I'm connecting dots that aren't really there. That's a fair thing to push back on. So let me just lay the verifiable pieces out flat and let you decide for yourself. The Shanghai Futures Exchange premium above $100 is real and verifiable. China's reclassification of silver as a strategic material with export restrictions is real and documented. The global silver deficit of 67 million ounces comes from a real industry report. Mexico's security situation in its major mining states is ongoing and real. Mexico's production decline since its 2021 peak is in the data. COMEX vault inventory declines are publicly trackable. Reports of Chinese institutional interest in rotating out of U.S. financial assets into silver have been circulating with serious sourcing. Trump's comments about potential military involvement in Mexico are on public record. China's state media accusations about U.S. interest in Mexican silver are documented. Every single one of those pieces is independently verifiable. I'm not asking you to take my word for any of it. I'm asking you to look at them together and tell me what you see. Because what I see when I look at them together is a pattern. Two competing powers maneuvering around a critical resource. At the exact moment, the world's primary source of that resource is collapsing from within. China is hoarding. China is restricting outflows. China is paying massive premiums. Washington is talking about Mexico. Washington is escalating tariffs. Washington is watching its own delivery vaults drain. And Mexico, sitting between them geographically and strategically, is producing less and less silver under more and more difficult conditions, with no path to rapid stabilization. If you already hold silver, the thing I want you to take from this analysis is that what you own has changed in character. It isn't just a speculative bet on a commodity cycle anymore. Increasingly, silver is being treated by the world's largest economies as a strategic asset. Strategic assets don't trade on the same logic as cyclical commodities. They trade on scarcity, on security, on the calculation of who controls supply and who gets cut off. When a metal enters that territory, the normal concept of a price ceiling starts to break down, because national security doesn't optimize around paying too much. It optimizes around not running out. And when both sides of a strategic competition are trying not to run out at the same time, price discovery becomes something very different from what we're used to seeing on a silver chart. If you don't hold silver, and you're watching this, trying to figure out what to make of everything, I'm not going to tell you what to do. What I will say is that the framework has changed. The variables that matter now are not the same ones that mattered in the last silver cycle. Inflation prints, Federal Reserve speeches, technical chart levels, these are not what's going to drive this market if what we're looking at here is real. What drives this market, if the story continues to develop the way the signals suggest, is access. Physical access to metal that exists in the real world. And access to that physical metal is getting harder, not easier, with each passing month. Drop your take in the comments below. Tell me whether you think this is a genuine financial war playing out through the silver market, or whether you think the connections are being overdrawn. I want to read your arguments. The most thoughtful responses from both sides, I'll pin at the top. If you know someone following silver without this kind of context, share this video with them. Understanding the mechanism matters more than just knowing the price. And if you want to keep getting this kind of analysis as the story develops, make sure you're subscribed and have notifications turned on, because this situation is moving fast. And I'll be updating it as new data comes in. The number that keeps pulling me back is 202 million ounces. That's Mexico. That's a quarter of the world. That's the swing producer. In a market already running a 67 million ounce annual deficit, that number is under stress right now, in real time. And two of the most powerful governments on the planet are actively positioning around it. The next time silver pushes up and tests resistance, remember what's sitting on the other side of that level. It isn't just technical momentum, or short covering, or inflation hedging. It's structural scarcity, strategic demand, and geopolitical urgency. That has no clean historical precedent in this market. Freight trains don't stop at lines drawn on charts. Stay sharp, stay informed, and keep watching this space, because this story is far from over.